Alphabet as well this morning. Shares are lower. Earnings did meet expectations. Revenue up 14, driven by search as well as cloud, which topped $10 billion in quarterly revenue and $1 billion in operating profit for the first time. But there was YouTube's ad revenue that did miss the mark. Joining us this morning, Alphabet shareholder Bill Nygren, portfolio manager and CIO US at Oakmark. Alphabet is his #1 holding. Bill, it's good to have you. A lot of discussion about the YouTube ad sales, but some takes this morning defending just how resilient search, at least, continues to be in this environment.
Yeah, it's funny, Carl. Every quarter when I come on, because Alphabet is one of our largest holdings, and there's been concern of what the AI effect would be on search, it's been one of the big questions is how do we get comfortable with Alphabet as a large holding? And the fact is that this is the 6th quarter in a row that the growth in search has accelerated. You've got a $200 billion business growing at 15%, and each quarter has been faster than the last. So our analyst actually raised their target this morning on what they think Alphabet is worth because the search growth is so much more important to value than the slight miss in YouTube.
As far as spending goes, there's obviously some CapEx worries among some, highest percentage of revenue in a few years. On the other hand, others argue pretty good operational efficiency, headcount down, margin beat. Which side do you take?
Well, we took a lot of comfort in how well controlled costs were in this past quarter. And I think Ruth generally gives conservative advice. Maybe she triggered some people when she talked about potential for expenses to tick up a little bit. But we're very happy with the margins and especially happy with how rapid the growth has been in search. And market share just continues as if it's the only company in the search business.
Bill, I know this comes up as a value name because we always talk to you about that, but I'd love to get your take on this big rotation that we've seen over these last few weeks in terms of the Russell. Can it continue? Are you happy about it?
Sure. In our portfolio at Oakmark, Alphabet is one of the only mega cap growth names we own. If you adjust for the losses in other bets and what the value of the cloud business, we think we're paying about 75–80% of the market multiple, and we think Alphabet's a better business than the market. But that's the exception for us. I wrote in my quarterly to shareholders that's available on oakmark.com about what a radical change we've seen in the S&P 500. It's become a concentrated growth fund because of the growth in the mega cap tech names. And I think it's important for investors to understand that it's a much riskier index than it used to be. We talk about Alphabet as our largest holding. It's in the high 3% of our portfolio. We like to think that Oakmark is a fund that investors could put most of their capital in, not look at it for a decade, and at the end of that time period be pretty happy with the results. But and because of that, we don't like to hold more than 4% in a name. But there are 4 names in the S&P 500 that are over 4% of the portfolio. So it's actually a more concentrated portfolio than the Oakmark fund, which is pretty concentrated relative to other mutual funds. So we think the smaller part of large caps, lower organic growth companies, the companies that haven't been doing very well in the stock market the past year, are a really attractive opportunity set today. And our portfolio is deeper in value territory than it's ever been.